And good evening, everyone. Time for another silver update. What you are looking at is the 8-hour chart here. Drawn a number of lines. One is the apparent trend line that we're following, and I've drawn a top line that corresponds to it. Looks like a trend channel. So we seem to be rising to the top of that trend channel now. Of course, we broke way out of it and crashed back to the bottom of it. So still seem to be in this trend channel, although we may be looking at sort of a range change, still something like this. Some kind of change out there. We may correct back up to that type of a channel. We'll have to wait and see. But for the time being, it seems like this upper channel has been broken and we're back to this older channel. Couple of other things I wanted to point out. First of all, obviously our MACD is reset to a historical low. We're talking about at least back to February, so a year and some months, a year and 3 or 4 months, we are reset back to there. The MACD does seem to be crossing over to the positive side. This often is the time when a reversal occurs, because in the longer term it continues down. So we'll have to wait and see if this breakthrough on the MACD continues up on this 8-hour chart. The other thing I wanted to point out about this chart, I've drawn a straight line up here from, it's not quite close enough to this line here, but it's close enough. But if you look here at the top of our volume, you can see we have an increasing volume that accompanied this sell-off. Now, in most stocks and commodities, when you have a top, you get a sell-off, a volume spike on the top. Now that would correspond with the top is right about in here. So what we would expect to see is a volume spike there, which corresponds to about here. That's not what we see. We actually see the volume spike corresponding with this bottom. So that's a very bullish sign. It doesn't mean we can't turn around and go down, but if we continue up from here, that's actually very bullish. What that means is the majority of this volume you see down here was actually buying, not selling. The selling was on the way down here. The buying was around this point here. So the bulk is the buying. So that's a potentially very bullish sign. We want to back out one more on the chart here and take a look at our MACD from longer term. We're approaching right about there, negative 0.44. So that rivals this low early this year, and it's close to rivaling what we saw in early 2010. Same with July, and then we've got one more that we really need to challenge as far as lows on the MACD, and that's the ultimate bottom around 850 back in 2008. So we're very sold off as far as the MACD is concerned. Of course, if we back out to the weekly, we are not. We are just correcting off of a spike top for the weekly. But if you'll note here, we had a correction and then a reversal. So we could do the same thing here and reverse. Only time will tell. So I'll have to wait and see. Wanted to jump out to the SLV because a lot of people have asked me to continue to follow the SLV. We want to look at the historical volume here. Today we put in 109 million shares on the SLV. Now that's significantly down from the 200 a day we were doing, and at the top 300 million. But you have to look at the volume up until this recent craziness. Really anything above 50 million was an outlier. Rarely did the volume of the SLV exceed 50 million. So today's 100 million is still twofold above the very high volume that we had seen in the past. So tremendous number of shares in the SLV are still turning over, and I don't personally believe there is any silver in the SLV. We're going to look at that a little bit in the article that we address next. And then of course we want to look at our option trader who was in the July 25 puts, and our July 25 puts still have an open interest of 124,000, pretty much sitting flat, 1900 changed hands, but looks like they've been mostly, since we checked it last, half buy and half sell, so we're staying around the range of 100 to 125,000 contracts outstanding. You can see it lost 24 cents, so it took an enormous hit today, an enormous hit, and it's down to 34.36 bid ask. So the price we saw it get filled back when it was initiated was 8-9 cents, so they're still sitting on a 300 to 400% profit, but you know, $2 rally. If we go back to 48, then these are going to probably go down below a nickel. So we'll keep an eye on those. The article I really wanted to look at tonight, I don't know if I'm going to have time to read the whole thing. Very important article. I saw it earlier today on Seeking Alpha, and then I noticed that Tyler Durden went ahead and picked it up. It's a fantastic article by Avery Goodman, and it really goes into depth and dissects what has been going on. So I'm going to go ahead and read it to you. I'm going to read as much as I can. I don't think I can read through the whole thing. It's really big. So I'll put a link to it and you can read it yourself. Avery Goodman says, in Anatomy of Silver Manipulation, how low can it go? As we warned our readers on May 1st, 2011, when silver had clawed its way back to about $48 per ounce, we expect another massive price attack in the next few days. We came to this conclusion based on a number of factors, including the impending opening of the Hong Kong Mercantile Exchange, which will be controlled by many of the same international players who control NYMEX. Like clockwork, a vicious attack, perhaps the most ferocious one ever mounted in the history of precious metals, began on Monday, May 2nd, 2011. We knew it was coming, but to be honest, we didn't expect the level of ferocity. Following our own suggestions, when silver had tanked by about 18%, we entered into a small speculative long position using the SIVR Silver Trust. The price punched right through the minor support level we had chosen and continued down. Had we realized the depth of the silver short seller despair, we would have played the game a bit differently. We would have waited longer, bought a lot more later on, and created a much longer term position. As it is, we have lost nearly nothing and will do it anyway. Nevertheless, as irrational as this kind of thinking is, and as much as we warn people against it, human beings are human beings, and we are not happy about putting on a little bet, no matter how small, that fails to catch the bottom of a dip. The level of despair among short sellers which is motivating this attack is growing. Anything could happen at this point. They could give up entirely, or the attack could become more ferocious. We don't know. What we do know is that the short sellers' predicament has grown worse. They will eventually become even more desperate than they are now as the weeks and months pass by. We will explain why shortly. New and even larger performance bond deposit requirements are being announced by NYMEX, so-called Clearinghouse Risk Committee, Performance Bond Committee, almost every other day. On top of these substantial increases, the individual clearing members are often making bigger demands and hiking up performance bond requirements even higher. We cannot help but wonder if some of these clearing members are themselves short silver, or if they are deathly afraid that the other clearing members will default, leaving them footing the bill. Or are they trying to help attack their own customers? To the extent that a clearing member is raising performance bonds above the level of the exchange, customers should say goodbye and never do business with them again. I absolutely agree with that. Anybody who's charging you more than is required margin above the exchange, I would take my business from that company right away. According the official spokesman for CME Group, which owns NYMEX, the performance bond increases are designed to address, quote, increased risk. If this were so, however, such changes would apply only to short sellers and new long buyers who have purchased up in the higher price ranges. Many of the older long buyers were sitting on huge profits from upward movement of silver when the new bond requirements were imposed in the $49 range. They posed no greater risk at all than they did back when they made their purchases at $18, $20, $25 per ounce, etc. But the exchange and its dealers don't play the game that way. Instead, they apply these changes to everyone, even people who may have bought when silver was down near $18 per ounce. Even though these older position holders pose no greater risk of defaulting than before, the exchange committee members are quite expert at all this, and are well aware that the net effect of what they were doing would be to throw people involuntarily out of positions. The effect is carefully calculated and thought out as part of the overall process used to artificially control silver prices. Coupled with the sudden increased performance bonds, there has also been an all-out media effort to convince people that a bubble is bursting. And you've seen that. I've documented, others have. There was a concerted, all-out, coordinated media attack against silver, which they had virtually never mentioned up until that point. So, definitely conspiracy, definitely coordinated. Even though, as we will shortly explain, anyone who is worth his salt as an analyst knows it isn't true. There's never been any bubble in silver in 2011, and therefore it cannot possibly burst. There's simply been an unwinding of a grossly underpriced asset that has been subject to multi-year price suppression effort. Be that as it may, this downturn provides for the first time in a long time more than mere gambling opportunities. Highly leveraged and undercapitalized speculators have been kicked out of their positions, and they had pushed the price of silver up very fast. It would have gone to the same levels anyway and beyond, but the process would have been slower and steadier if the market had been limited to cash buyers and well-capitalized investors. We have been carefully observing the methods used in this attack and have reached some conclusions. The attack is not sophisticated, it is not rocket science. The method is so simple that it is astounding that so few people see it for what it is. Regulators could put an end to it anytime they want to. They simply don't want to. That means, of course, that they are essentially complicit. There are genuine folks over at the CFTC like Commissioner Bart Chilton, but they are operating at an agency which is structurally corrupted, with a revolving door swapping employees to and from the regulator and those who are supposed to be regulated. The current price attack involves an overwhelming creation of transient short positions that last less than a day. This is expensive to do in terms of upfront cash, but it isn't quite as expensive as it may seem at first glance. Each day, except on Friday, May 6th, more than 10,000 short positions appeared to be transiently created, closed, and recreated during the day. This must have required posting at least $180 million in performance bonds. However, to give credit to the ingenuity of the manipulators, most cash is recouped by the end of the trading day. With access to the Federal Reserve loan windows, putting up an infinite amount of upfront cash in the morning of a trading day is no deterrent. From what we can see, this is what they are doing in a highly coordinated fashion. 1. Either using control over the exchange committee system to induce sudden hikes in performance bond requirements, or opportunistically using such hikes. The hikes soften up the market by causing an initial destabilization of accounts of over-leveraged long position holders. Some of the big clearing members of NYMEX have enhanced this effect by raising their own requirements higher than exchange committee and thereby softening up their own customers more substantially. 2. Using analysts to make extensive commentary to the mass media to the effect that the silver bubble has burst, in the hope of inducing fear in the marketplace, further softening it up in preparation for step 3. 3. Using trading bots to transiently create thousands and sometimes tens of thousands of intraday short positions designed to soak up opportunistic buying by better capitalized long-side-oriented investors. The flooding of the market with this paper supply of imaginary silver prevents futures-based prices from rising and triggers stop-loss orders among leveraged customers. 4. Closing most intraday positions into the into the mass of involuntary liquidations, sometimes artillery is left on the battlefield by the close of the day. This happens when transient short positions cannot be fully unloaded. In other words, the bots are competing with heavy buying from well-capitalized buyers who now want to pay at the bargain prices created by the bots and take over those positions before the bots have the opportunity to buy them back. This shows up as a net increase in the open interest in silver, even as the price is falling. That aberrant result is impossible if a bubble were really bursting, because we would have run out of such buyers by now. 5. Rinsing and repeating the same process the next day and on various days after that, allowing for a few updates centered around points of natural technical support in order to preserve plausible deniability. Again, CME officials claim that sudden margin changes are motivated by high volatility, and that their actions are not a cause for the recent crash of silver prices. That is disingenuous at best. The changes are not motivated by high volatility. They are the initial cause of the volatility. They knowingly destabilize the accounts of highly leveraged buyers. Those buyers were highly leveraged because the exchange previously encouraged high leverage by marking down performance bonds requirements. Sudden upward adjustment of performance bonds creates an opening for trading bots to move in and helps make manipulation less costly. It goes on and on. It's an excellent article. I wish I could read the whole thing to you, but it's just too long. And he does the best case I've seen recently of someone showing that this was a coordinated attack. They knew exactly what they were doing. Open interest is increasing, not decreasing. So all the evidence we can see right now is that this is not a bubble, that it was a coordinated attack by the CME, the CBOT, the CFTC, and even the SEC, regulators who should be trying to stop the manipulation of silver, but who are actually complicit in the manipulation of silver, because silver represents the potential ending of the fiat money regime. So we'll talk to you next time.